Alright, question 1A talks about on September 1st, 2020, Delia Company issued $264,000 worth of bonds at par with an interest rate of 10% per annum. The bonds will mature on August 31st, 2022. Interest will be paid annually on August 31st, and the company has a December 31st year end. So we need to look at, what is the accrued interest payable as of December 31st, 2020. So we take the bond par value being $264,000 times the interest rate of 10% as indicated here, and then the number of months that we need to accrue for, which from September 1st to December 31st would be 4 months out of a full year. So taking our calculation, 264 times 10% times 4 months divided by 12 in a year equals an accrued interest payable of $8,800. Alright, question 2A, we have the situation where on April 30th, 2020, a company issued $600,000 worth of 4% bonds at par. The term of the bonds is 10 years, and interest is payable semi-annually on October 31st and April 30th. The year end for the company is November 30th, and record the journal entries related to interest for the first 2 years of 2020 and 2021. So that speaks to where we need to record the accrued interest payable. So the first payment is on October 31st, which happens to be before the year end. So on October 31st, we will have a calculation to perform for the first 6 months cash interest paid. So we take the value of the bonds of $600,000 times the rate of 4% times the fact that the interest is payable for 6 months out of 12, which gives us an interest expense of $12,000, and that is paid with cash. Moving forward to their year end, being 1 month later, we have the $600,000, 4% for 1 month, which means we need to accrue interest payable, credit to interest payable, debit to interest expense for $2,000. 600,000 times 4% times 1 month out of a full year. Rolling forward to the April 1st, 2021 payment then, we need to calculate the interest for another 6 months. So we take the 600,000 times the 4% times a half a year, 6 months out of 12. That'll give us the total payment of $12,000 that we will make to the bondholders. We need to credit cash. We need to reverse the interest payable that was accrued from November 30th. So we have a debit to interest payable for the $2,000 from the previous transaction. And therefore our interest expense for that appropriate period of 5 months would be $10,000 debit to interest expense. Rolling forward to October 31st, 2021, same as October 31st, 2020, 600,000 times 4% for half a year. So we have $12,000 debit to interest expense and $12,000 credit to cash. Our final entry then would be November 30th of 2021. Same transaction as November 30th of 2020, where we have to accrue 1 month of 4% on 600,000, debit to interest expense, credit to interest payable for $2,000. Question 3A, we had a company who issued a $500,000 note bond but only received $475,000 in cash on February 1st, and we're just asked simply to record the journal entry to record this transaction. So we will debit our cash that was received, $475,000. We need to credit bonds payable for $500,000 being the face value of the bond. So therefore there was a discount on the bond worth $25,000, which will be a debit to that said account. That discount would then be amortized over the life of the bond. Moving on to question 6, we have Marquis Corporation who issued $1.5 million worth of bonds with a 9% interest rate. Interest is payable semi-annually on June 30th and December 31st. The bonds mature on June 30th, 2027. At the time of the bond issuance, the market interest rate was 8%. Any discount or premium resulting from the sale of the bonds will be amortized using the straight line method. And the company's year end is March 31st. So in this example, you'll see on my screen, I've set up a number of items, so we'll walk through those calculations. So using Excel, you can actually calculate present value using built-in functions. So what I've done is indicated the key drivers. So we need to know the principal. So the bond's principal is $1.5 million. We need to know the interest on that principal is 9%, compared to the market rate being 8%. How many years is that bond? 7. And because it's semi-annually payments for interest, the payment periods would be 14. So there are 14 payment cycles for interest. So to calculate the present value then, we take the principal, okay, we take the market rate for the discount, because you always discount the present value based on the market rate, not on the coupon rate. And you also will take the number of periods, so it's over 14 periods, okay, based on half of the market rate. Or if you did 8% for 7 years, it'll result in the same. So using the Excel calculations, which should tie to a financial calculator instead of the present value tables, we have 866,212.62. I will upload a copy of this Excel file to the FOL site as well. So you'll see the formula in here is equal to the present value. Actually, I think I can pull it up here. Yes, I can. So the present value, the rate, I said divided by 2. The number of periods is 14, so it's linked to those cells. There's not a regular payment. Okay. The future value, we want it to be 1.5 million, and it's at the end of the cycle. So it gives us the present value. The present value of future interest payments then, similarly, a couple of key differences. We can use the same present value function within Excel. We will look at the fact that every 6 months, what is our market rate? 8% divided by 2. Number of periods would be the 14. How much is the payment? Is the 67,500 interest. F value, is there a future value? No, because we're making payments over a period of time. And type is 0, meaning it's the end of the period. So that calculates 713,010 and some change. So our present value of the future interest payments plus the present value of the principal of the bonds would be 1579223. So then what I've done is I've set up the table, because whenever you're doing present value, whether it's for a capital lease, whether it's for a notes payable, whether it's bonds, premiums, or discount, it's always nice to set up the schedule that's associated with that item. So I've set up this little table at the bottom left-hand side of the screen, where we start with the original issuance of bonds on July 1st. There was a premium issued, and the bond book value would be 1579223. Then we go through forward, and every 6 months there'll be an interest payment calculated at the flat coupon rate, which gives us an interest cash payment of 67,500. We're also told to amortize the premium or discount, in this case a premium, straight line. So we'll divide that by the number of periods, and you'll see that there's a small rounding. So we've rectified the final payment just to make sure the premium was 0 at the end. The interest expense, there's the difference. Because it's a premium, it'll reduce the interest expense over the period or the lifetime of the bond. Then we can calculate what is the premium or discount balance. In this case, you'll see the premium value declines over time. And you'll see our bond book value slowly gets back to the 1.5 million face value. So using this table of information, we can then calculate our journal entries. So we're asked to calculate our journal entries for the first couple of years. So we have July 1st, we received cash from our bond holders of 1579223. We have a bond payable of 1.5 million, but we have a premium on our bonds payable of 79,223 that needs to be credited. So debit to cash, credit to premium, credit to bonds payable for the amounts indicated. As of December 31st, we will make our first cash payment of 67,500 to our bondholders. Our interest expense would be debited for the 61,841 calculated as per our amortization schedule, and our premium on bonds payable will be debited again for 5,659 to reduce the amount of the premium remaining. If we move forward to March 31st being the fiscal year end for this company, we need to accrue the interest payable. So I've connected it to our table just to divide by 2, taking half of the interest expense for that period. So if you're following along the workbook, there might be a $1 rounding up or down. That's okay. The idea is the concept is the interest expense then would be half, so it's 30,921. You would half the premium bonds, so debit to premiums, 28.30. So the interest payable would be 33,751, adding the two transactions. If you had 33,750 and you rounded one of these other items in the debit side to balance, that's okay, as long as your journal entry is in balance, of course. Moving forward to June 30th, then, when we pay cash, credit to cash for 67,500, we then need to remove the interest payable that we've accrued as of March 31st of 33,751 as a debit. And then we need to record the interest expense and premium reduction as per the schedule for the rest of those 6 months. So what I did in this case was I connected the June 30th journal to the amount that was expected for the full 6 months. So the total premium premium amortization was 5,659, less the amount that we recorded as of our fiscal year end. And same with the interest expense was 61841 for 6 months, less the amount that we accrued for the first 3 months, so 3920. And then we have our balanced journals being 67,500 on both sides. If you were to carry forward this entry into the future, it would follow the same cycle. So you could use this chart in theory to, actually in reality, to support all of your journal entries for the whole period that you hold those bonds. All right, one last question we'll do, and then if you have other questions on other application examples, please feel free to reach out. So it's question 13. We're looking on January 1st, 2020. Cedar Company issued a 5-year, 8% installment note payable for $120,000, and this is to finance upgrading its current equipment. The company's year end is December 31st. The repayment of $14,795 is done and completed semi-annually on January and July 1st. So let's assume an equal installment amount of $14,795. We need to fill in this table to determine the total interest expense over the 5-year term. So I've set it up in Excel here. We have the different columns of information, the date that the transaction occurs, what the cash payment is, etc. So our opening balance on January 1st, 2020 will be the $120,000 note payable. Our interest payments, we're told, are $14,795 every cycle, so we can complete that column. And then to calculate our interest expense, we need to calculate 6 months worth of interest on the principal balance prior to that payment. So in this cell, okay, you'll see that I've put in a round formula to take the balance prior to that payment of $120,000, so that's cell E12, times the rate, which I've linked it to 8%, and then we want 6 months out of 12, so you'll see times 6 out of 12. So 6 months out of 12 will determine our interest expense, and I want to round that to have no decimals. Okay. So our reduction of the principal then is the difference. So if we take our total payment of $14,795 less the $4,800 in interest, the rest goes to the principal, being $9,995. So our principal balance then reduces down to $110,005. You would then roll forward that transaction. You'll see that the interest expense declines over time, which makes sense because our principal drops every 6 months. Therefore, our interest expense calculation will slowly decrease. If you see this right now, if you continued these calculations all the way to the end, there is a small rounding error. So I've set up this table where if I have a rounding error, I can just override it, record its interest expense, because we need the principal to show a zero balance at the end of the term. And those are the examples.